clearly we see pricing is going to be a bit of an issue, particularly against a wall of volatility that we've seen over the past couple of weeks or so. What is it about Japan that you like?
Good morning, Heidi. Well, Japan just fits into our broader narrative of thinking around global exposure to equities as we see the economic cycle move from something that's been early recovery into more mid, but continue to tilt towards those cyclical sectors and regions of the world that have that cyclical slant, as we do expect this ongoing recovery to push ahead into next year. And we just look at the sector weights within Japan, it fulfills that story. And also that relative valuation argument that you mentioned, if we look at the valuations in the US or Europe, and the strong performance they've had this year, it does point towards the Japanese market maybe having a little bit more of a pickup for investors as we think about those more attractive values. And as well, the earnings outlook for Japan for next year is also in check with what we're seeing in the US and Europe. If we look at consensus forecasts, this year the earnings outlook has lagged what we've seen elsewhere, but next year it's very much looking like a more steady state for Japan, US and the Eurozone, but the valuation's much better when we think about the Japanese outlook.
Kerry, we're building up to an interesting year, I think, or an interesting start to the year when it comes to the divergence between major central banks. And at the moment, that's what our question of the day from our MLive blog is really asking. Who are the major winners and losers when it comes to the PBOC easing and the Fed tightening? Where do you see that divergence play out?
I think most importantly, it's probably going to play out in the currencies. First of all, if we look at what's happening of late, I mean, the US dollar had been on a very strong run this year, as it looked like the Fed was going to be leading the way in terms of the rate outlook. The movement around the Bank of England has also been tempered a little bit most recently by Omicron, and what that might mean as banks just sort of wait and see what the near-term implications of the fallout from the economy could be. But it does seem, if we look at the economic health, the US is definitely very much leading the way in terms of the tightening in the labour market, the strength in the economy, and the rhetoric coming from the Fed around the fact that they will likely increase the pace of their taper and move on rates earlier than expected. And so that does leave them well ahead of other central banks. And we will continue to think that would support the US dollar relative to those countries like the Japanese yen or like the European Union, where we're going to see those currencies still be anchored by that low rate outlook.
What about the yuan? Because we have seen such a resilience, right? We're talking about 6-year highs against a basket of currencies. So are you going to see the same weakness in the Chinese yuan when we continue to have this divergence? And what would that mean for other currencies around Asia that, of course, rely heavily on where the yuan goes?
Yeah, I think that separation we've seen, just the triple R rate cut that we've had overnight coming through in China does indicate that, the Chinese officials and the PBOC are very much focused on stabilization of the economy. I mean, we don't see a huge support for credit from that cut. It's more of a neutral view, given that it's probably offsetting some liquidity measures that were expiring elsewhere. But it reinforces that signal that they're really looking at trying to stabilize that outlook for the economy, and they're going to take further measures to support that and still have this zero COVID approach to the economy, which could restrain growth a little bit in the near term, whereas you contrast that to what's in the US. And we would expect that to play out within the currencies as well. The difference may be as we see the recovery around the world strengthen and we look at Asia and how it reacts to the Omicron variant this time compared to the Delta variant and the more strength position we have there. There's a greater appetite to look at Asian and ASEAN assets in particular for that reopening story and the better valuations that are going to come through there relative to developed markets.
How does the Omicron variant affect your portfolio outlook? Does it change meaningfully what you're doing with your assets, or is this just another downside risk?
We haven't changed our core view as towards having an overweight towards equities, underweight towards government bonds, as probably many people have. But it does represent a greater downside risk to that outlook. I think the trouble right now is there's just not information really to make a sustained view on how this will play out. And that means the markets are going to remain choppy for the next couple of weeks as they sort of battle with this variant versus vaccine kind of view on the world and all the different news flow coming through. And it's also come when we've already had concerns around heightened valuations across many parts of the world and some sectors in particular. And then we throw into the mix the outlook for the Fed and tightening rates. That just adds up to more volatility as we head into the end of the year. But I think fundamentally, if we look at how the global economy is going, some of the improvements we've seen in supply chain metrics, all that does really much support the view that the economy is getting better, that the earnings outlook is positive, and we should still be focusing on risk assets and equities in that environment.